G'day there. Welcome to Inside Business. Well, Australia's not on the edge of a fiscal cliff, but the government does need to increase its tax revenue to climb out of deficit. The new mining tax is not going to help, so a ravenous Treasury seems to have turned its attention to multinational companies that seem to have made the payment of tax optional. And to get the debate going, Assistant Treasurer David Bradbury has actually fingered Google's tax strategies. We'll also catch up with Santos boss David Knox, who's got a huge spending pipeline ahead, just as it seems the resources boom has peaked. And we'll check out the latest from the AGM season, what's behind the switch to cyclicals, and the CEOs who've been selling their shares. Should you join in? Assistant Treasurer David Bradbury did an unusual thing this week. In a speech to the Institute of Chartered Accountants Tax Conference, he described how a particular taxpayer, Google Australia, is going about avoiding tax. It's called the Double Irish Dutch Sandwich. And as David Bradbury told the conference, you just have to Google it and you get a YouTube video explaining how it works. Here's a bit of it.
Hi, I'm John with Tax TV, here to explain the Double Irish and the Dutch Sandwich. This isn't a lead-in to a joke or a new food you'll find, but a tax strategy that can help international corporations save money on U.S. taxes. These tax techniques have been used by a number of technology companies, most notably Google.
Now, it gets a bit complicated after that, but essentially what happens with Google, according to the Assistant Treasurer, is that Google's clients in Australia actually buy their advertising from an Irish subsidiary of the American company. Ireland's tax rate is 12.5%, which is a lot less than ours. But wait, there's more. Here's the sandwich. There's a second Irish holding company that's controlled in Bermuda, which has no tax at all. The first Irish company pays a tax-deductible royalty to the Bermuda Irish company via a Dutch subsidiary of Google that sits in the middle. And because transfers within the EU don't attract withholding tax, it's all tax-free. Now, after David Bradbury described this snack to an audience that probably knew more about it than he did, Ross Lyon of Rio Tinto got up and said, well, that's all very well, and if you close that down, you might make a bit more from Google, but what if the Chinese government decides to tax Rio and BHP at the source of their sales, that is, in China? You'll be in real trouble then. The question is, and it is a momentous one for all governments in the digital age, are Google's sales in Australia an export from Ireland, in the same way that Rio Tinto's sales of iron ore in China are an export from Australia? If so, the tax belongs to Ireland or even Bermuda. Where does the intellectual property and the business reside? It's not Australia. It's not America. Australian customers of Google are actually dealing with an Irish exporter of search advertising services, one that really does pay a royalty to a Bermuda company via the Netherlands. As David Bradbury told ABC Television this week,
the international tax rules that were created very much for the industrial age are now failing to properly address commerce as we know it in the information and digital age.
Or to put that another way,
all these techniques are legal and used by many international corporations to help reduce taxable income. Now take some time to digest this information and then check out TaxTV.com for more appetizing tax strategies.